What about the medium term and how to deal with the volatility in the market? That's something that we'll try and decode with Sridhar Sivaram, the investment director at ENAM Holdings, joining us on the show right now. Hi Sridhar, good to be speaking with you. Thanks so much for dropping by. How are you dealing with this volatility?
I think some bit is expected. We've had a one-way market for a very long period of time. So I think it's par for the course. It's good. I mean, a lot of people were expecting some sort of a correction or wanting a correction.
Hoping for a correction, more
whichever way you put. I mean, I saw interesting statistics on this that on a monthly basis, closing basis, we haven't had a 5% correction for Nifty for now 54 months. So the last was in March 20, which is the COVID month. So this is the closing monthly correction. And the previous best was around 30 months. So we are at 54 months without a 5% monthly correction on Nifty.
We've been in fool's paradise.
Yeah, so actually it's, I mean, even now with this, for all you know, by the end of the month, if the market recovers, you don't have a 5% monthly correction. And so these are very things which don't happen so often. So it's good. Let's enjoy as long as this lasts. But on a macro basis, things look reasonably good. We can discuss about it as we go.
But are you churning your portfolio in a big way right now in terms of sectors, in terms of allocation, in terms of, let's say, the cash call, large cap, mid cap calls?
Yeah, so we prefer the large cap right now. I mean, just look at the market. If you take just last 1 year, the Nifty is up 25% and the mid caps are up 40% despite the correction that we've seen. When you get such strong rallies, you do see some bit of pullback or a time correction, whichever way you see, and earnings also have to catch up. So it's, I mean, the way we look at our portfolio is to be in stocks where we have reasonable surety or our confidence on the earnings is strong, and try to be in better stocks where management quality is good, or maybe slightly defensive, pharma, whatever. I mean, wherever we think the earnings quality looks better.
And you had flagged off in the past that inflation has been a bit of a concern, and I think managing growth and inflation, of course, continues to remain the RBI's key priority. How do you see the trajectory of interest rates moving, and what is it that you're expecting? Will we go the Fed way, or will we continue to chart our own course?
Yeah, so I'm not in the camp which thinks that we are going to get massive rate cuts. So we'll see the inflation number which comes now. We'll have a 5% handle in that because the two previous months had a favorable base effect and people were getting carried away with the base effect, calling for 50 basis points rate cut and stuff like that. I don't think at best we get a 25, maybe end of the year, because of the interest rate differentials. If Fed continues to do another 50 basis points, we could get a 25. But then I don't see our inflation going structurally below 4, at least in the next 12 months. So I can't see Reserve Bank really cutting in an aggressive way. Maybe they'll adjust liquidity in the interim. So I'm not in the camp where we think that interest rates will go down. But we've done well even despite interest rates not being down. So I don't think it matters so much. Actually, our markets are used to high interest rates. So it's very different from the US market, which has got used to very low interest rates. So I think our performance of our markets with low and high interest rates don't vary as much. More important is how the earnings shape up for the companies.
I have to talk about how is it that you're analyzing the China piece, right? I mean, part of the camp believes that it's tactical money which is moving in. I mean, what else would explain the kind of FI exodus and the selling that we've seen month to date in the last 1 odd week or so? And part believe that if money were to move to EM funds, China may be a higher allocation, but India also will find inflows.
Yeah. So let's put China in perspective, and I'll take the Hong Kong China index. It's called the HSCEI. The March 20 low was around 9,000. Our March 20 low was around 8,000 the day when the markets crashed. They are now at 7,500, okay, and we are at 25,000. So let's put things in perspective that market has got decimated. So obviously when markets fall so drastically, you will get violent recoveries, and we've had this every year in the last 3 years where we've seen China markets rally for 30-40% and then they give up again. I'm not an expert on China, but from whatever I have read, they have an issue with earnings. The economy is deflationary right now, and there are pockets where earnings are good, but otherwise it's more a value play. Plus, there are macro issues and geopolitical issues with the US. So, when I speak to my ex-colleagues and funds from the US, fund managers who manage US money, there are a lot of stocks which have sanctions where they can't buy because of US related issues. So, I don't think this is structural, my view, and we see this tactically every year. And it's a 25% weight in the MSCI index. Fortunately, India has also gone up past 20% now. So, we are reasonably big. So, it's difficult for FIs to ignore India. And there have been only two markets, if I take the last 10-year performance of MSCI, there have been only two markets which have given any amount of reasonable returns. India is around 8-9% and Taiwan is also similar range. And the rest have all been basket cases. I mean, China is literally zero. Emerging market itself has not given any returns. So, I think I always question this asset class, even though I've been in this business and was part of an emerging markets team. I think this asset class is seriously under question. It hasn't given any returns for more than 10 years. I think we'll see outflows from the emerging markets over a period of time, and maybe regional specific indices will take over. That's how I see it.
Yeah, you're questioning the asset allocation there, but you've been a strong proponent of gold in the portfolio, right? And that's done massively well for people this year. What's the take from here on?
Yeah, so I've been a big bull on gold. I mean, my basic view is at least you should have 10% allocation in gold. The 20-year performance of gold is very similar to the Sensex returns, roughly 14% CAGR. And you can take any period, 1 year, 3 year, 5 year, roughly gold has matched Sensex. Maybe there are periods where Sensex has done better and there are periods where gold has done better. But the point here is more on asset allocation, and the other thing which people underestimate, that gold is a hedge against the currency also. So, if our currency over 5 year, 10 year depreciates at a CAGR of 3%, this is a hedge which gives you that return plus the gold returns. So, as I said, I've always maintained that the Indian woman is the best fund manager. By just buying gold, she has outperformed most fund managers over the last 20 years. And we keep cribbing about some of my male fund managers who don't like my comments, saying that this is India's current account deficit is going out of hand. Gold is because of gold imports. Yeah. But people don't realize that the gold loan market is now almost 8 lakh crores.
Yeah.
So the argument that this is a lazy asset, doesn't generate any economic value, is also proved wrong because of the huge gold loan markets that we have. I can go on and on this, but the simple point is at least you should have 10%. If not,
despite
if you're not there,
the run up, fresh buying is absolutely okay.
Our markets have also run up, right?
That's true.
Yeah. So it's a question of, it's a store of value.
Yeah.
And if you see what has changed in the last, say, 2 years, is that central banks have become very aggressive. And I think that is also coming from what happened to Russia after the embargo, and US suddenly closed the the currency market for Russia. So most countries and central banks feel that what if this happens to us someday? So if you see, a lot of central banks have started to add gold, but irrespective of whether central banks add or not,
you should add it in your portfolio.
Yeah, you can't predict that every year it will give you the same return. Same with our markets. I mean, if I remember right, in the last 20 years, gold has had only 3 down years. So it's been a very stable asset class. So I think I rest my case.
You make a good case for it, for sure.
Yeah, but what's not been stable, or at least when it comes to earnings, and this is something that you've also brought up, is what's going on with the mid and the small caps.
Yes.
Are you still firmly of the view that large caps is a safer place to be?
So actually, mid and small cap, it's such a big basket that we do find interesting ideas there where we can see strong earnings growth. Like power sector is something that we really like. A lot of the power equipment companies are in the mid and small cap space, and they are growing at say 30-40%. A lot of the EMS companies are in the mid cap space. They are growing at 30-40%. Obviously, these stocks have also rallied, but we think where there is earnings support, these mid and small caps can continue growing. I don't think re-rating will happen, but at least they can give you the earnings returns. So it's very difficult to if I look at the overall PE of the mid and small cap, obviously they look expensive, but there are pockets which look reasonably good. Large cap, obviously there are a lot of sectors within large cap which looks quite interesting. They haven't participated. Financials is one such segment. So we think at this stage in the market they look far safer. I mean, that's how I'll put it. We don't expect this market to substantially go up in the next 6 or 8 months. We could see consolidation here, we could see time correction, and these are stocks which could give you some returns. That's how we feel. I mean, obviously we can be wrong, nobody can predict the markets, correct?
Yeah, I was just going to come to that, because what gives you that conviction? Unfortunately, each time they begin the move, something happens in the market or the sector falls flat or something else does better.
So that's Aisha, that's how we looking at the market, that in the mid and small cap we look at companies which have strong earnings. At least our visibility is good. I mean, we could be wrong even there. So we know that a lot of them have corrected, but at least we know that the earnings are strong. And in the large cap, we look at historic valuations and get comfort from that. There are times when stocks don't give you returns for maybe 3 years, 2 years. I mean, ITC was a classic example for not giving returns for 10 years.
Back in the day for almost
I mean,
a decade.
you can go back in history and see many of these stocks, but when they give the returns, it is multifold. So it's very difficult to predict. But even if I take a 3-year period, most financials have given returns. I mean, we were big on PSU banks. Obviously, we have cut back our position. But even now, we have a few PSU banks where we see good 30% earnings growth, and some of them are in the mid cap space. So as I said, it's very difficult to say in this market that this sector looks good, because in each sector there are some companies which look really good, some are slightly overvalued. It's the skill of the fund manager which plays now. Maybe 3 years back you could just pick a sector, and if it does well, as I explained about PSUs 3 years back, I mean, you just buy a PSU mutual fund and just ride it. I mean, that game is over. So now it is the skill of the fund manager.
Yeah, because within sectors also there's so much polarization,
exactly.
right? So when you talk banks, I mean, are you talking the ones which have already sort of won the race, or are you talking about more the bottom-up stories that you are betting big on?
See, the large cap private sector banks, if I take the next 5 years or next 10 years, they still look good to me, because if India has to grow, I mean, they currently have certain issues.
So you're saying buy a basket of it.
Yeah. So see, if RBI is forcing these banks to get their CD ratios in order, the only way you can get is if you get more deposits, which in a tight liquidity condition is slightly difficult, or you reduce your loan growth. So most banks are doing both, which has an impact on their earnings. But these are cyclical issues. On a structural basis, I don't see this being a larger issue. So it's okay. I mean, some banks will do well, some banks may not do well for a period. But on a structural basis, I don't see an issue with this. And as I said, PSU bank, the broad play is over. Now what is left is specific banks which have specific stories. Some have excellent CASA ratios and stuff like that. So then you play that. I mean, those are really specific bottom up ideas that we generate.
I was also going through some of the public disclosures and some of the kind of holdings that you have, and clearly there seems to be a shift away from consumption as such. I don't see a direct play, let's say, on autos or real estate. There's a lot of OEM and the second level kind of EMS plays there. But is that a conscious call, staying away from consumption?
Yeah, no, actually that's not true. I mean, it's in the public domain. We recently added to an airline which is a discretionary consumption, and
I'm guessing it's Indigo.
Huh? So we are quite bullish on airlines, aviation, anything related to that. I mean, any of us, when we go to the airport, we know what is happening there. But on a broader basis, in the number of commercial planes that India has is 700. Just compare that with China, it's about 4,000. And people underestimate that the two busiest airports, Delhi and Bombay, both are going to get a new airport in the next 1 year. So today, Bombay is a constrained airport. Even if you want, and I fly to a lot of the smaller destinations like say a Jabalpur or a Bareilly. I mean, the rates that I pay is just absurd because there isn't enough landing slots in Mumbai.
Yeah.
Once this changes, and as the number of planes go up and more of the smaller towns are connected, this is a structural story. And the popular belief is that airline is a capital intensive business, which isn't now. because of the sale and
Leasings
lease
and
back. So it's
everything,
basically a variable cost and how efficiently you manage cost. So discretionary consumption is something that we look at, especially slightly in the mid and higher end. At the lower end, we think because inflation is still high, we think it will still disappoint. I mean, we are seeing some early signs from FMCG companies reporting recently.
Yeah.
It is showing that that is still not picked up.
And what about the IPO rush? Is it a bubble? In the last 2 months, 22 companies raising funds?
Yeah, so I think we've stayed away from most of it. It's
Not
it
getting
reminds-
any FOMO there.
Yeah.
God, the same
It
question.
reminds me of 21. There was a phase in 21 where these IPOs were
Zomatos
like,
and Nykas of the world had
everybody
come,
wanted
PTM.
to get a piece of it.
Like the Coldplay tickets.
Yes,
Yeah.
didn't apply for that also. But I think it's. I mean, the market's been very kind, and I don't see why the promoters should not raise. So if the market is kind, giving them good valuation, so be it. I mean, it is the right time for promoters and companies to do an IPO, and it is for the markets to figure out whether. I mean, we are seeing some of the companies correct very sharply after the IPO gains.
Yeah.
At the end of it, it has to be earnings. So if the earnings follow through, these companies will do well.
Yep, and the big ones are still in the pipeline. That's both Swiggy as well as Hyundai. But so great having you in the studio.
Thanks for inviting me.
as
Thanks a lot.
always.
Yeah.
Okay, let me.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.